All right, let's talk about BigBear.ai. As we're looking at this, the U.S. markets are closed for the weekend. BigBear.ai, ticker BBAI, finished Friday session November 14, 2025, closing at $6.06 per share. That was a rough day, ending down 28 cents, which is a significant drop of 4.42%. Now, the moment you see a stock like this, a small-cap company with AI right in its name, the expectation is almost immediate. Most investors, especially those just starting out with online investing, immediately lump it into one of two buckets. The first bucket is the lottery ticket, the expectation that this is a speculative, high-risk bet that could either go to zero or become the next 10-bagger. The kind of stock people chatter about on forums hoping to catch lightning in a bottle. The second bucket is the hype train, the belief that this is just a company riding the massive tailwinds of the AI narrative, benefiting from the glow of giants like Nvidia stock, without having the fundamentals to back it up. The expectation is that you're just betting on the initials in the ticker, not the business. But the reality of what's happening with BBAI right now is far more complex, and frankly, much more telling than just AI hype. That 4.42% drop on Friday wasn't just random, skittish retail selling. If you look at the intraday trading data from Friday, the volume was actually somewhat concentrated, with a few significant block trades passing through in the final 2 hours of the session. This wasn't just 1,000 people on the Robinhood app hitting the sell button. This looked more like institutional repositioning, perhaps a fund trimming its position heading into the weekend after a very volatile week. The stock gapped up earlier in the week on news and then bled out. This $6.06 close is critical because it puts the stock right back on a key technical support level. The 50-day moving average sits just below this, and if it breaks that $6 psychological barrier on Monday, the technical picture gets a lot uglier, potentially opening the door for a slide back into the $5 range. Let's really get into the recent performance because that is what is driving this bus. The company just reported its third quarter 2025 earnings back on November 10th, and the market's reaction has been a case study in expectation versus reality. The headline numbers were messy. Revenue for the quarter was $33.1 million. On one hand, this beat the consensus estimate, which was closer to $31.8 million. That's the expectation met part. But the reality is that this $33.1 million represents a 20% decline from the same period last year. That's a huge contraction. The company also reported a GAAP net income of $2.5 million, which looks fantastic compared to the $15.1 million loss last year. But again, the reality underneath is what matters. That income was almost entirely due to a $26.1 million non-cash gain from changes in the value of derivative liabilities, basically accounting moves on warrants and convertible notes. The actual operations, as measured by adjusted EBITDA, showed a loss of $9.4 million, which was significantly worse than the $0.9 million gain in the prior year quarter. So you have this incredibly confusing picture. Revenue beats expectations but is down 20%. The company reports a profit that isn't from operations, and the core profitability metric, adjusted EBITDA, fell off a cliff. On top of that, they announced they were acquiring a company called Ask Sage for $250 million. This is the context for that 4.42% drop. The market is digesting this chaotic information. The expectation was for clarity on growth. The reality was a complex, muddled report that shows a company in the middle of a very expensive transformation. This is where you have to separate BBAI into two distinct companies. First, you have the Federal Solutions business. This is their legacy, their bread and butter. They provide AI-powered analytics and decision support to the U.S. defense and intelligence communities. These are sticky, long-term contracts. The expectation is that this provides a stable, predictable revenue floor. The reality, as shown in the third quarter report, is that this business is not stable right now. Management directly blamed the revenue decline on lower volume on certain U.S. Army programs and shutdown headwinds. This is the problem with government work. It's subject to budgets, politics, and program delays. This isn't like Apple stock where you can count iPhone sales. This is a lumpy, unpredictable revenue stream that is currently shrinking. Then you have the commercial solution side. This is the growth story. This is the blue sky scenario. They're trying to take their defense-grade AI tools and sell them to private companies in logistics, manufacturing, and healthcare. The expectation is that this is the high-margin, scalable software business that will eventually justify a much higher stock price, making it a worthy addition to a self-investing growth portfolio. The reality is that this is an incredibly difficult and expensive pivot. They are competing against everyone from niche startups to Palantir to the cloud giants themselves. A logistics company looking for supply chain optimization tools has 1,000 options. BBAI's Q3 report didn't provide the blockbuster commercial numbers investors were hoping for. The pipeline was mentioned, but pipeline doesn't pay the bills. This acquisition of Ask Sage is a huge bet on accelerating this commercial and federal generative AI push, but it's also a $250 million bet that adds risk. Let's talk about who is holding this stock because it's fascinating. When you're managing your own money, perhaps in an individual brokerage account at a place like Fidelity or Interactive Brokers, you have to decide what kind of stock this is. Is it a long-term hold for your Fidelity IRAs, or is it a short-term trade? The institutional 13F filings give us clues. We see a lot of passive index funds like those from Vanguard. BBAI is in the Russell 2000, so any broad small-cap Fidelity ETFs or Fidelity mutual funds will hold it by default. This is just automated buying, not a statement of belief. However, the more active holders are what's interesting. We've seen some tech-focused hedge funds trim their positions, clearly uncomfortable with the cash burn and the shrinking federal revenue. At the same time, you see new, more speculative funds rotating in, drawn by the low price and the AI name. This churn in ownership, where long-term believers are replaced by short-term traders, is a classic recipe for the kind of volatility we saw on Friday. This isn't a stock for someone who just wants to use Schwab Intelligent portfolios and forget about it. This is a stock for an active, hands-on investor who checks their Fidelity mobile app or Interactive Brokers platform daily. This is the kind of high volatility name that platforms like Robinhood Stock Trading and SoFi Invest thrive on, as it attracts users looking for fast action, often through Robinhood fractional shares. But the risk is immense. This brings us to the macroeconomic reality. The macro environment is an absolute nightmare for a company like BigBear.ai. We are in a high interest rate environment. The Federal Reserve has made it clear that higher for longer is the strategy. For a company like Tesla, which is wildly profitable, high interest rates are a manageable headwind. For a company like BBAI, which is not consistently profitable and is burning cash, negative $9.4 million in adjusted EBITDA, high interest rates are an existential threat. Why? Because the cost of waiting for future profits becomes too high. An investor can get a safe 5% return from a treasury bond. Why would they risk their capital on a speculative, small-cap AI company unless the potential upside is massive and imminent? This macro pressure squeezes the valuation multiple for all high-growth, non-profitable tech. BBAI is stuck in that vice. So for those who are just getting up to speed, what does this company actually do? Their products have names like Observe, Orient, and ProModel. The simple version is they create AI-powered software that takes in massive, messy data sets from a client. Think sensor feeds, logistics reports, intelligence chatter, and it builds a model of their operations. Then it allows the client to run what-if scenarios. A military commander can model the logistical impact of moving troops. A shipping company can simulate disruptions at a port. The expectation is a high-margin, scalable software-as-a-service, SaaS business. The reality, especially on the federal side, is that this often involves a lot of lower-margin professional services, consulting, custom integration, and training, which can drag down overall profitability and make it harder to scale. Looking forward, what's the future outlook? What are the catalysts that could break this stock out of its $6 rut, and what are the risks that could send it lower? The primary positive catalyst is a landmark commercial win. The expectation is built on this. If BBAI can announce not just another